The collapses of FTX, Silicon Valley Bank, and Signature Bank, among others, have dominated the headlines recently and sent shockwaves through the financial world. Here to help us unpack the complexities of these cases and the similarities between them, as well as the long-term impact on financial markets, is Dr. Stein Smith, a CPA and assistant professor at City University of New York Lehman College. I'd like to start with the FTX collapse. In your estimation, what went wrong and what are the long-term impacts on the cryptocurrency world?
Based on all of the courtroom testimony, documentation, and evidence that has been published to date, what happened at FTX, even though FTX was a major player in the blockchain crypto asset space, didn't really have anything to do with blockchain or crypto assets. Rather, it honestly can be honed down to a complete failure of corporate governance, having no internal controls, having no CFO, and then also having the entire enterprise, which at its peak had a enterprise valuation of over $30 billion, being controlled by a group of about 10 people who had total control over the company, its operations, its underlying source code, and also had been dating each other at various points. So all of that isn't a great culture to have a large enterprise handling billions in external customer funds. In addition to the corporate governance failures and all the rest, they actually created their own token, right? The FTT token, Serum, and a few others. So they had this internally created intangible asset, put it on their balance sheet, and then based on trading volume of about 5% of these tokens, basically said, well, now it's worth billions of dollars. So there's a lot to go over there at FTX, but it was basically a pretty straightforward example of a poorly managed enterprise that, and allegations are out there, had been operated as a fraud from almost the onset, but ultimately boils down to internal control errors, corporate governance not being there, and really some questionable internal bookkeeping that ultimately was not caught.
Well, as a result of the FTX collapse, what should individual and organizational investors consider when thinking about adding crypto to their portfolio? Is it still even a good idea?
It is worth noting that Fidelity, BNY Mellon, and JP Morgan, three of the biggest financial institutions in the US and in the world, have all, during the last 12 to 18 months, actively launched either their own products and services for their customers or are developing their own tokens and enterprise blockchains. So on the one hand, the optics right now aren't great, but anybody in the space knows that basically there are always peaks and some valleys. So I would say that for any individuals or for any firms that are interested in onboarding either blockchain or trying to take tokens as a form of external payment, I would caution now to be sure to do your homework up front, right? And sort of by that, I mean, talk to your board, talk to your insurance carrier, talk to your regulators, and try to do it in the most not piecemeal way possible, but I would say try to do it in iterations, right? Do it part A, part B, test it, and see how it works.
Are there any commonalities between the collapse of FTX and, for example, Silicon Valley Bank and Signature Bank?
Both banks were not directly impacted by FTX, but the increased uncertainty combined with higher interest rates, higher inflation, and higher instability in the markets and some panic on social media basically caused both of these institutions, which don't forget were the two of them are the second and third largest bank failures in U.S. history, to happen in 48 hours.
So, what are the implications of these collapses for the accounting profession, and what can or should the accounting profession, what role should they play in trying to be part of the solution.
Going forward, right, as all of us know, automation, analytics, bots, RPA, blockchain, crypto, whatever, all of that is altering how our work is done. But all of us have to be more proactive in one, embracing tools like this, two, integrating them into our internal processes and our conversations to our external clients, and then three, we collectively have to do a much better job, I think, at being clear as to one, what audits are, and two, what audits are not, right? Because ask the average person on the street, ask them what an audit is, and they'll probably think that a audit means that every transaction is examined and that everything is 100% okay. That isn't quite the actuality yet. Now, ultimately, that will happen, I think, and probably pretty soon, of a full 100% audit or a continuous audit.
You think the tools that you just talked about can truly help prevent these kinds of collapses if it is a full 100% audit?
A full audit that integrated aspects of your blockchain applications, tokenomics. What are these tokens? How is their valuation assigned? Where are they trading? And then who actually controls them? That, I believe, wouldn't have stopped the bad behavior from occurring, but it definitely would have helped external investors, regulators, customers to understand those actions prior to the whole enterprise collapsing, right? Because bad behavior is always going to happen, right? And so our tools and our processes can help us catch it earlier